Imagine being told that you already have everything you need to become a successful investor. Imagine discovering that the greatest advantage you could ever have is not insider information, elite education, or sophisticated financial tools. It is simply paying attention to the world around you. This is the message at the heart of One Up on Wall Street by legendary investor Peter Lynch, the man who turned the Fidelity Magellan Fund into one of the most successful investment funds in history. Lynch delivered an average annual return of nearly 30% over 13 years, one of the best track records ever recorded. His philosophy is simple but powerful. Ordinary investors can beat professional investors if they observe trends early, understand what they invest in, stay patient, and trust common sense instead of hype and fear. One Up on Wall Street explains how everyday people can identify valuable investment opportunities long before Wall Street does. Lynch argues that successful investing is not about timing the market or predicting economic cycles. It is about understanding what you buy and holding it long enough to let the business grow. Most investors fail not because they lack intelligence, but because they lack discipline. They panic too quickly, react to headlines, follow the crowd, and sell at the worst possible moment. Lynch says, "The key to making money in stocks is not getting scared out of them." His message is clear. The real enemy of investing is emotion. One of the most important ideas in the book is that individual investors have a unique advantage because they live in the real world. They interact with new products, stores, services, and technologies before analysts read about them in reports. Lynch encourages investors to look for companies they encounter in everyday life. Do you notice a store that is always crowded? A product everyone suddenly wants? A restaurant gaining popularity? These real-world observations can reveal opportunities before they appear in financial news. Lynch calls this investing in what you know. He famously invested in companies like Dunkin' Donuts and Heinz simply because he saw their real-world performance around him before the rest of the market paid attention. His strategy is grounded in a simple truth. You do not need genius to recognize a good business. You just need awareness. Another major concept in One Up on Wall Street is the classification of companies into 6 categories, each requiring a different investment strategy. The first category is slow growers, large and stable companies that grow steadily and pay dividends. These companies offer safety but limited upside. The second category is stalwarts, reliable companies with steady earnings growth like Coca-Cola or Procter & Gamble. They provide moderate growth and can be great long-term holdings. The third category is fast growers, small and rapidly expanding businesses with enormous potential. These are the most exciting opportunities, but they require research and patience. The fourth category is cyclicals, companies whose success depends on economic cycles, such as airlines, steel, or automotive. The fifth category is turnarounds, struggling companies that could recover and deliver massive returns. The sixth category is asset plays, companies whose assets are undervalued or hidden, such as real estate or patents. Lynch teaches that investors must understand what type of company they are buying. A fast-growing company should be judged by growth potential, not dividends. A slow-growing company is valuable for stability, not explosive returns. A turnaround requires belief in change. A cyclical stock requires precise timing around economic cycles. Problems arise when investors confuse categories. For example, treating a cyclical stock like a fast grower leads to disaster. Lynch insists on clarity. Know what you own and why you own it. Another powerful lesson in One Up on Wall Street is the importance of research. Lynch encourages investors to read annual reports, learn about company leadership, study financial performance over years rather than months, and understand how a company actually makes money. You do not need to be a financial expert to do this. You simply need curiosity. Lynch says, "Never invest in any idea you cannot illustrate with a crayon. If you cannot explain a business simply, you should not invest." Complexity is often a disguise for weakness. One of Lynch's most famous tools is the price-to-earnings ratio, or PE ratio. This number compares a company's stock price to its earnings. If a company is growing quickly but has a low PE ratio, it might be undervalued. Lynch looks for companies whose growth rate is higher than their PE. For example, a company growing at 20% with a PE of 10 could be a great opportunity. This formula is not rigid, but it helps identify value and avoid overpriced hype. Lynch also argues that ignoring short-term market noise is crucial. Stock prices constantly move up and down based on emotion, politics, rumors, and temporary events. Most people react without thinking, buying high when excited and selling low when afraid. The media intensifies this cycle. If you watched financial news every day, you would be convinced the world is ending weekly. Lynch says that despite endless distractions, the stock market has always gone up over the long term. Companies grow, economies expand, and time rewards patience. The market may fluctuate wildly month to month, but historically, it has always rewarded long-term investors. Lynch offers a powerful analogy. Investing is like growing a tree. If you plant seeds and uproot them every week to check their progress, nothing will grow. If you plant them, water them, and leave them alone, you get a forest. The same principle applies to wealth. The real secret is time. One Up on Wall Street also teaches the importance of knowing when to sell. Lynch does not believe in holding a failing company forever. If the story changes, the investment should change. If growth slows dramatically, if leadership collapses, or if competition destroys advantage, it is time to reconsider. But decisions should be based on the business, not temporary fear or emotion. Too many investors sell winning stocks too early and hold losing stocks too long. Lynch says, selling your winners and holding your losers is like cutting the flowers and watering the weeds. Another major theme is avoiding the herd mentality. When everyone is buying blindly, danger is high. When everyone is panicking, opportunity is high. Lynch argues that the greatest investments often appear boring, unpopular, or ignored at first. By the time something makes headlines, the profit is usually gone. The best investors are independent thinkers, not followers. The biggest takeaway from One Up on Wall Street is that ordinary people can outperform professionals by using observation, patience, common sense, and discipline. You do not need to predict the future. You simply need to recognize value when it appears in real life. Lynch encourages investors to think long-term and ignore short-term chaos. In 20 years, the temporary drops that terrify people will not matter. What matters is owning great companies and letting them grow. So, what can you apply today? First, look around you. What products or services are improving life? What brands are people excited about? Second, understand the businesses behind the stocks you consider. Third, categorize the company correctly. Fourth, avoid emotional reactions to market swings. And finally, be patient. Time multiplies your returns more than anything else. That was One Up on Wall Street by Peter Lynch, broken down into its most powerful lessons. What part of Lynch's philosophy stands out to you most? Investing in what you know? Staying patient? Or avoiding emotional decisions? Share your thoughts in the comments, And if you enjoyed this summary, make sure to like this video, subscribe to 10-Minute Books, and tap the bell so you never miss our weekly deep dives into life-changing books. Remember, investing success is not about timing the market. It is about time in the market.